Most people think foreclosure means someone failed. In Florida, foreclosure increasingly means someone ran the numbers. When insurance triples, property taxes surge, and home values fall, homeowners face a brutal choice: keep paying into an underwater asset or walk away and rebuild. This isn't about panic. It isn't about irresponsibility. It's about math, not abstract math, monthly math, the kind that makes staying more expensive than leaving. Tonight, we're breaking down Florida's foreclosure wave, who's defaulting, why it makes financial sense for some, and where displaced homeowners are moving next. This is the moment foreclosure stops being emotional and becomes rational. Florida's foreclosure wave isn't being driven by unemployment or recession. It's being driven by impossible math. Insurance tripled, property taxes doubled, home values fell by roughly 30%. And suddenly, homeowners found themselves trapped, owing more than their homes were worth while monthly costs kept climbing. Consider a family that bought a Tampa home in 2021 for $400,000 with 20% down. They invested $80,000, their entire savings built over years. They financed $320,000 at 3.25% interest, creating a monthly mortgage payment of $1,392. Add insurance at $500 a month, property taxes at $650, HOA fees at $300. Their total monthly housing cost came to $2,842, about 39% of their $8,800 monthly gross income. Tight, but manageable for a dual-income professional household. By 2026, everything changed. Insurance jumped from $500 to $2,200 a month, a $1,700 increase. Property taxes rose to $950 as millage rates increased. HOA fees climbed to $675. Their new monthly costs looked like this: mortgage $1,392, insurance $2,200, taxes $950, HOA $675. Total monthly housing cost $5,117. That's 58% of their $8,800 monthly income, before utilities, groceries, healthcare, or transportation. But here's the part that confuses most people. The mortgage payment didn't change. It stayed at $1,392. So why would they even consider foreclosure if they could technically keep paying? Because two realities intersected, and together they made staying irrational. First, the home's value collapsed. Their $400,000 purchase dropped to roughly $300,000. They put $80,000 down and paid about $23,000 in principal over 5 years. In theory, they should have over $100,000 in equity. Instead, they were underwater. They owed about $304,000 on a home worth $300,000. Second, the cost of ownership no longer made sense. They were paying $5,117 a month, more than $61,000 a year, to own a home they could rent for $3,500 a month. Renting the same home would cost about $42,000 a year. That's a $19,400 difference every single year. So the choice became brutally clear: continue paying over $61,000 a year into a negative equity asset, burning nearly $20,000 annually compared to renting, while hoping prices recover someday. Or walk away. Accept the 7-year credit impact. Rent for $42,000 a year. Save $19,000 annually. Rebuild credit and buy again later, in a market that actually works. That's what strategic default really is. It's not irresponsibility. It's not failure. It's a financial calculation. When staying means throwing good money after bad into an underwater asset with no visible recovery timeline, walking away becomes the rational choice. And this isn't isolated. Across Florida, homeowners who bought between 2020 and 2022 watched values fall 25 to 35%, while monthly costs surged beyond sustainability. They're trapped between two bad options: keep paying unsustainable amounts for negative equity, or walk away and accept foreclosure consequences that may actually improve their financial future. And once you understand this math, you realize something even more important: selling isn't an option anymore. Number 2, the underwater epidemic. What turns high housing costs into foreclosure isn't the cost alone. It's what happens when homeowners realize they can't sell. Negative equity, owing more on a mortgage than a home is worth, is what creates foreclosure waves. When homeowners still have equity, even shrinking equity, they have an escape route. They can sell, take a loss, and move on. But once they're underwater, that escape disappears. Selling suddenly requires bringing cash to the closing table, money most families don't have, especially after years of rising insurance, taxes, and maintenance costs. And this isn't rare. It's widespread across Florida. In Miami, nearly half of buyers who purchased between 2020 and 2023 now owe more than their homes are worth. The median purchase price during those years was around $620,000. Today, the median value has fallen to roughly $496,000. That leaves many homeowners underwater by $85,000 to well over $100,000, depending on how much they put down and when they bought. Fort Myers is even worse. More than half of recent buyers are underwater. Homes that sold near the peak for about $410,000 are now worth closer to $294,000. That's a drop of more than 30%. For many households, negative equity runs from $70,000 to over $100,000. Fort Myers has one of the highest concentrations of underwater homeowners in the state because values fell sharply while insurance costs exploded after Hurricane Ian. Tampa isn't far behind. Roughly 43% of recent buyers are underwater. Homes that sold for around $415,000 at the peak are now closer to $309,000. That leaves typical negative equity between $65,000 and $95,000. And Tampa's foreclosure activity is already running several times the national average, the highest of any major Florida metro. West Palm Beach tells the same story. Nearly half of recent buyers owe more than their homes are worth. Peak purchases averaged about $540,000. Current values sit closer to $434,000. Negative equity often falls between $75,000 and $110,000. Cape Coral is no exception. Almost half of recent buyers are underwater, with canal-front properties hit especially hard. Values on those homes declined faster than non-waterfront properties, leaving many owners short by $60,000 to $90,000 or more. When you add it all up, the scale becomes impossible to ignore. Across just these 5 Florida metros, roughly 230,000 homeowners who bought between 2020 and 2023 now owe more than their homes are worth. They can't sell without bringing cash. They can't refinance at today's rates, and they're stuck carrying monthly costs they can't sustain. And that number still understates the problem. It doesn't include homeowners who technically have a little equity, but not enough to escape. A homeowner with $15,000 in equity who faces $30,000 in selling costs and moving expenses is effectively trapped. They walk away with nothing after years of payments, just like someone who's underwater. In practical terms, minimal equity behaves the same as negative equity. Once homeowners realize they can't sell their way out, foreclosure stops being a last resort and starts becoming inevitable. Another group is collapsing even faster than homeowners. Small landlords, not hedge funds, not billion-dollar firms, but ordinary individuals who bought 2, 3, maybe 5 rental properties as a retirement strategy and are now watching those properties bleed cash every single month with no exit in sight. Consider a landlord who bought 3 rental properties in Tampa in 2021. Each home cost about $375,000. They put 25% down on each one, roughly $93,750 per property. Across all 3 homes, they invested about $281,000 of their own money. At the time, the math worked. Each property rented for around $3,900 a month. After mortgage payments, insurance, taxes, and routine expenses, the portfolio generated positive cash flow. Values were rising. Mortgage balances were falling. On paper, the landlord was building roughly $180,000 a year in combined appreciation and cash flow. Then 2026 arrived. Insurance on each property exploded, from about $525 a month to $2,200. Property taxes jumped from roughly $630 to $901. Suddenly, each property flipped from income-producing to loss-producing. Each home was now losing about $1,119 every month, and that's before vacancies, repairs, or tenant problems. 3 properties losing $1,119 a month equals negative $3,357 monthly. That's more than $40,000 a year just to keep the properties afloat. At the same time, values declined. Each home dropped from $375 to roughly $345, about $30,000 per property. Across 3 homes, that's $90,000 erased in equity. Added together, $40,000 in annual cash losses, $90,000 in lost equity. That's over $130,000 in wealth destruction in a single year, on a portfolio where the landlord invested $281,000 total. At that point, the decision stops being emotional. It becomes mathematical. Continuing to pay means pouring tens of thousands of dollars every year into assets that are worth less than what was paid for them, with no realistic path back to profitability. So landlords make a hard choice. They stop paying the mortgages on the rental properties, they protect their primary residence, they accept the credit hit, and they shut off the cash bleed immediately. This isn't speculation. Foreclosure filings show that roughly 1 in 4 foreclosures in Tampa, Miami, and Fort Myers today involve investment properties. Landlords walking away after years of negative cash flow finally exhausted their ability to subsidize losses. They didn't miscalculate rents. They didn't over-leverage recklessly. They were crushed by insurance, taxes, and declining values, the same forces hitting homeowners, but multiplied across multiple properties. And once landlords capitulate, something else happens. Those homes don't return to owner occupants. They move straight into foreclosure pipelines where the next buyers are waiting. For retirees, this crisis becomes something much darker because there's no income rebound coming. Retirees with remaining mortgage balances face a uniquely cruel situation when rising costs collide with falling home values. They can't work more hours to absorb higher expenses. They often can't refinance because they no longer have employment income to qualify. And when they're underwater, they can't sell. That leaves foreclosure as the only exit from an impossible equation. Consider Robert. He's 73 years old. He bought his Port St. Lucie home in 2022 for $280,000, putting 10% down. $28,000 pulled directly from retirement savings. He financed $252,000 at 5.75% interest, planning to pay the mortgage off over 15 years using Social Security and a small pension that together brought in about $4,200 a month. At the time, the numbers worked. Barely. His mortgage payment was $1,472. Property taxes were about $360. Insurance was $350. His total housing cost came to $2,182 a month, roughly 52% of his fixed income. That was high, but calculated. He had $400,000 in retirement savings to help cover healthcare, maintenance, and unexpected costs until the mortgage balance fell and housing costs eased later in retirement. Then the math broke. By 2026, property taxes climbed to $650 as millage rates doubled. Insurance exploded to $1,200 a month, an $850 increase. His new monthly housing cost was $3,322. That's 79% of his $4,200 in fixed income. After paying for housing, Robert had $878 left each month. Medicare premiums and prescription costs took about $600 of that. That left $278 for food, utilities, gas, phone service, and home maintenance, everything else required to survive. To close the gap, Robert began withdrawing about $1,500 every month from retirement savings. At that rate, his $400,000 would last roughly 22 years. He's 73. His life expectancy is around 88, 15 more years. The math only works if nothing goes wrong. One serious illness, one hospitalization, one long-term care event, and his savings run out before he does. But here's the trap that seals it. His home fell in value to about $220,000. After 4 years of payments, he still owed roughly $237,000 on the mortgage. He was $14,000 underwater. He couldn't sell without bringing cash he didn't have. He couldn't refinance without employment income, and the home itself no longer supported the loan. Robert was trapped, paying over $3,300 a month into a negative equity asset while draining the savings meant to support him for the rest of his life. So he made a decision no retiree ever wants to make. In November 2025, Robert stopped making mortgage payments. He continued paying property taxes and insurance to protect the home while he lived there, but the mortgage payments stopped. He'll remain in the house through the foreclosure process, typically 12 to 18 months in Florida, preserving nearly $40,000 he would have spent on mortgage payments during that time. After foreclosure, he plans to rent a smaller apartment for about $1,200 a month. That one decision preserves his remaining retirement savings for healthcare and survival during his final years. His credit will be damaged for 7 years, but at 74, when the foreclosure finalizes, he's not buying another home anyway. For him, credit scores no longer matter. What matters is not outliving his savings. And Robert isn't alone. Foreclosures among retirees are rising faster than any other demographic in Florida. People in their 70s choosing strategic default not because they failed, but because preserving retirement assets for healthcare and survival outweighs protecting credit they'll never use again. Another foreclosure trigger is neither financial recklessness nor job loss. It's relocation. Families facing job transfers, divorces, or life events that require them to move are discovering that Florida's frozen housing market turns mandatory moves into financial disasters. They must leave, but they can't sell. They can't afford to keep paying for a home they no longer live in, and foreclosure becomes the only realistic exit. Consider Jennifer and Michael. They're both 37. They bought their Jacksonville home in 2021 for $300,000. In August 2025, Jennifer's employer, a financial services firm, relocated her entire division to Charlotte. She was given 4 months to move or resign. Michael, a regional sales manager, found a comparable role in Charlotte as well. Their Jacksonville home, however, told a different story. Its current market value had fallen to about $250,000. After 4 years of payments, they still owed roughly $272,000 on the mortgage. They were $22,000 underwater. Selling wasn't possible. To close the sale, they would have needed to bring $22,000 in cash just to cover the negative equity, plus about $15,000 in selling costs. That's $37,000 they simply didn't have. So they explored every alternative. They tried renting the home, but Jacksonville rents had fallen to around $2,400 a month. Their mortgage, insurance, and taxes totaled about $3,200. That left an $800 monthly shortfall. Covering that deficit from Charlotte, while also paying $2,200 a month in rent there, meant an extra $24,800 per year in housing costs they could not afford. They attempted a short sale, asking the bank to accept market value and forgive the difference. The lender refused unless foreclosure proceedings were already underway, which defeated the purpose. They tried refinancing to lower the payment enough to make renting work. Denied. They no longer had employment income in Jacksonville, and the home's value didn't support the loan amount. That's when the trap became clear. They could quit their jobs and stay in Jacksonville, hoping the market recovered someday. Or they could move to Charlotte, protect their careers, and let the Jacksonville home go. They chose their livelihoods. In September 2025, they stopped making mortgage payments on the Jacksonville house. They relocated to Charlotte in October and began renting. The Jacksonville property now sits vacant, moving through the foreclosure process, likely completing in late 2026. They'll lose whatever equity they might have had. Their credit scores will take a significant hit, but there was no option that didn't involve sacrificing careers or draining every dollar of savings to maintain a home they couldn't sell. And this isn't rare in Jacksonville. The city leads Florida in job transfer-related foreclosures, driven in part by the heavy military presence at Naval Air Station Jacksonville. Active duty service members receiving transfer orders face the same impossible math. Underwater homes they must vacate, no ability to sell without cash they don't have, and foreclosure as the only realistic exit. Once relocation collides with negative equity, foreclosure isn't a choice. It's the consequence of a market that no longer functions. When foreclosure forces families out of Florida, the next question becomes unavoidable. Where do they go? Florida's foreclosure wave is displacing hundreds of thousands of households, and the destinations they choose reveal what people value after the Florida experiment ends, and what Florida no longer offers. The largest share is heading to Georgia. Roughly 1/3 of Florida foreclosure migrants are relocating there, with Metro Atlanta absorbing most of them. Atlanta offers job markets comparable to Tampa and Miami, but housing costs 50 to 60% lower. A family foreclosed out of Tampa moves to an Atlanta suburb, rents a similar home for about $1,800 a month, finds comparable work, and suddenly realizes their total cost of living dropped by roughly $25,000 a year, even though their salaries barely changed. Next comes Tennessee. About 21% of displaced Florida households relocate there, especially to Nashville and surrounding counties. Tennessee offers what originally drew many people to Florida: no state income tax. But without the housing cost explosion, home prices run 40 to 50% lower than Florida, and insurance costs are often a fraction of what Floridians were paying. Families who move to Florida for tax reasons discover Tennessee delivers the same tax benefit without the financial stress. The Carolinas together capture nearly a quarter of Florida's foreclosure migrants. Charlotte dominates for professionals, offering a job market that rivals Tampa's. Raleigh-Durham attracts tech and biotech workers displaced from Florida's collapsing affordability. Charleston draws retirees who once sought coastal living, but at costs that no longer made sense in Florida. North Carolina, in particular, attracts families with children, driven by stronger school systems and more stable public funding than Florida's increasingly strained education budgets. Texas attracts a smaller but still significant share, about 11%. Despite the distance, cities like Houston, Dallas, and Austin pull in families seeking strong job markets, no state income tax, and housing costs well below Florida's. For households willing to reset completely after foreclosure, the economic opportunity outweighs the geographic separation. Then there's the reverse migration. Ohio, Michigan, and Indiana together absorb roughly 13% of Florida's displaced homeowners. These are often returns to origin states, people moving back closer to family networks after the Florida dream collapsed. Even with state income taxes and colder weather, the math works. In Ohio, for example, combined property taxes and insurance often total around $8,000 a year, compared to $25,000 or more in Florida. That $17,000 annual savings more than offsets state income taxes for most households. When you look at these destinations together, a clear pattern emerges. Displaced families prioritize housing affordability first, job stability second, quality of life third. They're no longer chasing weather, amenities, or lifestyle branding. They're chasing sustainability. Florida promised sunshine and lifestyle, but delivered insurance shocks, tax acceleration, falling values, and frozen exits. The states attracting Florida's displaced are offering something far less exciting and far more important. Reasonable housing costs, predictable expenses, functional job markets, and housing systems where buying and selling still work. After foreclosure, people don't want paradise. They want stability. One fear keeps many families trapped in homes they can't afford. Credit damage. Foreclosure does hit credit hard. Scores typically drop 150 to 250 points. A household with a 720 score can fall into the low 500s, making mortgages impossible and even car loans expensive in the short term. But what most people misunderstand is how predictable the recovery actually is. The damage is severe at first, especially in the first year. Mortgage access disappears. Families rely on renting, larger deposits, and strict budgeting while rebuilding. Then something changes. As the foreclosure ages and no new negative marks appear, credit begins to recover. Within 2 to 3 years, scores often climb back into the low 600s. Auto loans become affordable again. Some buyers even requalify for FHA mortgages with larger down payments. And after 7 years, the foreclosure drops off entirely. At that point, credit is judged only on recent behavior, not the past collapse. That's why timing matters. A family choosing strategic default at 35 regains full credit access in their early 40s, still within peak earning and home buying years. A retiree choosing foreclosure in their 70s carries credit damage into their 80s, but they're not buying homes at that stage anyway. In both cases, the trade-off becomes clear. 7 years of damaged credit versus years of ongoing cash flow destruction, depleted savings, and no exit. For many families trapped in negative equity with unsustainable costs, that's not a reckless gamble. It's a rational exchange. While families lose homes to foreclosure, another group is quietly positioning itself to profit. Institutional investors. As foreclosures accelerate across Florida, large investment firms are buying distressed properties at massive discounts through bank liquidations and courthouse auctions, then converting those homes into long-term rental inventory. Companies like Invitation Homes, American Homes for Rent, Progress Residential, and dozens of smaller institutional operators are actively acquiring Florida foreclosures, targeting neighborhoods where displaced homeowners will soon need to rent. The math behind this strategy is straightforward. A bank forecloses on a Miami home with a remaining mortgage balance of $450,000. The home's current market value is around $380,000. The market has softened, but the property still has real value. The bank doesn't want to own real estate. Holding the property costs money. Prices may continue falling. Insurance, taxes, and maintenance add risk. The bank's priority is to liquidate quickly and recover as much capital as possible. An institutional investor steps in and offers $275,000. That's roughly 72% of market value and just 61% of the original mortgage balance. The bank accepts. $275,000 today is better than hoping for $350,000 months later in a declining market. The investor acquires the property for $275,000, invests about $40,000 in repairs and cosmetic upgrades, and then markets the home as a rental for $3,500 a month. That generates $42,000 in annual rental income. Now look at the operating costs. Insurance runs about $12,000 annually. Property taxes are roughly $9,000. Maintenance and reserves add another $5,000. Total annual operating costs come to around $26,000. That leaves $16,000 in net operating income on a $275,000 purchase, a 5.8% cash-on-cash return before financing. But that's only part of the advantage. Institutional investors don't borrow like individual buyers. They secure portfolio financing at rates individuals can't access, often around 4.5% compared to 7% or more for retail borrowers. They have capital reserves large enough to absorb vacancies and market swings, and they buy in bulk, negotiating discounts that require minimum purchases of 20 to 50 properties at a time. That structural advantage changes everything. The family that lost that Miami home to foreclosure now rents, often from the same investor who bought their property at a 25 to 30% discount. The investor collects $3,500 a month on a home they acquired cheaply from the bank that foreclosed on the family. This cycle repeats thousands of times across Florida. Families lose homes to foreclosure, banks liquidate distressed assets, institutional investors buy at discounts. Homes convert to rentals. Former homeowners and families just like them become long-term renters in properties now owned by corporations that profited from the foreclosure wave. This isn't a temporary imbalance, it's a structural shift, and once ownership transfers at scale, it rarely reverses. What's happening in Florida isn't a temporary shock that fades when markets recover. It's a structural transformation. Florida's foreclosure wave is permanently shifting housing away from owner-occupied homes and toward institutional investor-owned rental markets. Before 2020, roughly 11% of Florida homes were owned by institutional investors. By 2026, that figure is estimated to be closer to 27% across major metro areas. That represents roughly 1.1 million homes that have transitioned from owner-occupied or small landlord ownership into large corporate portfolios. And that shift carries consequences that don't reverse easily. First, homeownership rates decline, not temporarily, but permanently. Families who lose homes to foreclosure don't re-enter ownership quickly. Credit damage alone keeps most out of the market for 7 to 10 years. During that time, they're also rebuilding depleted savings, paying higher rents, and adapting to long-term renting. By the time many could theoretically buy again, ownership no longer feels attainable or even desirable. Renting becomes the default, not the bridge. Second, rental markets become less competitive for tenants. When a large share of rental inventory is controlled by institutional owners using centralized pricing algorithms, rents don't fall the way they do in markets dominated by small landlords competing independently. Prices stabilize higher, concessions disappear faster, and tenant bargaining power weakens. Third, communities lose stability. Owner-occupied neighborhoods tend to attract families with long-term stakes in their homes and communities. Maintenance, school involvement, neighborhood cohesion all flow naturally from ownership. As those homes convert to rentals, turnover increases. Institutional owners optimize for returns, not community continuity. Neighborhoods become more transient, and long-term social investment erodes. Fourth, wealth building collapses for displaced families. For decades, home ownership was the primary wealth-building tool for middle-class Americans. Equity growth, forced savings through mortgage payments, and intergenerational transfer all flowed from ownership. When foreclosure removes families from that pathway, and credit damage blocks re-entry, an entire generation loses its most reliable mechanism for building and transferring wealth. Finally, political consequences follow. As homeownership declines and rental dependence rises, political pressure shifts toward tenant protections, rent stabilization, and landlord regulation. But institutional investors possess sophisticated lobbying power that individual renters don't. The result is a stalemate, a growing renter population with increasing vulnerability and decreasing leverage over housing policy. All of this produces a two-tier housing market. On one side are owner-occupants who bought before 2020 or who have sufficient wealth to absorb today's insurance, tax, and maintenance costs. On the other side are renters, families who lost homes to foreclosure or can no longer qualify for mortgages, now dependent on institutional landlords for housing. What's disappearing is the middle-class pathway of buying a first home, building equity, and trading up over time is being systematically erased by foreclosure waves and market dysfunction. And once that middle disappears, it doesn't come back easily. One reason Florida's foreclosure wave moves more slowly and more strategically than people expect is the process itself. Florida is a judicial foreclosure state. That means foreclosures must move through the court system, not just through a lender's internal process. And that creates a long timeline, often allowing homeowners to remain in their homes for 12 to 24 months after they stop making payments. Understanding that timeline changes how families think about their options. The process begins quietly. When a homeowner first stops making mortgage payments, the lender doesn't immediately take legal action. Notices are sent, collection calls begin, warnings escalate, but no lawsuit has been filed yet. During this period, homeowners are generally advised to continue paying property taxes and insurance. That keeps the home protected and prevents tax liens or coverage lapses that could create additional problems later. After several months, the tone changes. Typically, within the first 1 to 3 months, the lender sends a formal notice of default. The letter demands full payment to cure the delinquency and warns that foreclosure will follow if payment isn't made. For most families, curing the default isn't realistic. If they had the money to catch up, they wouldn't have fallen behind in the first place. This stage is less about resolution and more about setting the legal groundwork for what comes next. Around the fourth month, the foreclosure becomes official. The lender files a foreclosure lawsuit in county court. The homeowner is formally served legal papers, and the judicial process begins. From that point, the homeowner typically has about 20 days to respond. Many don't. Failing to respond allows the court to issue a default judgment, which speeds up the process. Others contest the foreclosure, triggering legal discovery and extending the timeline. Either way, most families are still living in the home and no longer making mortgage payments. This middle phase, roughly months 5 through 8, is critical. If the homeowner contests, legal proceedings drag on. If they don't, the court moves toward scheduling a foreclosure sale. In both cases, families are still occupying the home while preserving funds they would otherwise be spending on unsustainable mortgage payments. This is also the window when alternatives are explored: loan modifications, short sales, or deeds in lieu of foreclosure, though many of these options fail when homes are underwater or income no longer qualifies. Eventually, the court issues a final judgment. Usually between months 9 and 14, the judge authorizes foreclosure and schedules an auction date. The property is listed for sale, typically at a courthouse auction. The sale date is published, giving the homeowner clear notice of when ownership will legally transfer. The auction itself typically occurs around months 15 to 18. The property is sold to the highest bidder. In many cases, the bank buys it back for the loan balance. In others, an investor purchases it at a discount. After the sale, the new owner must provide formal eviction notice, often allowing an additional 30 to 60 days before eviction can be enforced. If the homeowner hasn't left voluntarily, eviction follows. Between months 18 and 24, the sheriff enforces eviction if necessary. The family must vacate, and the property officially transfers to its new owner, either a bank or an investor, who then decides whether to resell it or convert it to a rental. This long timeline matters more than most people realize. A family with a $3,000 monthly mortgage payment who remains in the home for 18 months preserves roughly $54,000 they would have otherwise paid into an underwater asset. That money becomes moving costs, rental deposits, emergency savings, or the foundation for rebuilding after foreclosure. For many households, strategic default combined with remaining in the home through the foreclosure process doesn't weaken their financial position. It improves it, compared to continuing to pay unsustainable costs into a property they cannot sell. In conclusion, when you examine Florida's foreclosure crisis, from the impossible math-forcing strategic defaults to the institutional investors profiting from family displacement, one truth becomes unavoidable. This wave wasn't caused by family irresponsibility. It was caused by policy failure and market dysfunction. These families aren't defaulting because they were reckless. They aren't defaulting because they lost their jobs. They're defaulting because insurance tripled, property taxes doubled, and home values fell by roughly 30%, creating situations where continuing to pay causes more financial destruction than foreclosure itself. They're making rational calculations. 7 years of credit damage versus decades of throwing money into underwater assets with no recovery in sight. The retirees choosing foreclosure to preserve end-of-life savings aren't irresponsible. They're making tragic choices between protecting a credit score and protecting healthcare funding in their final years. The landlords walking away from properties bleeding $40,000 a year aren't quitters. They're stopping wealth destruction that would eventually bankrupt them if allowed to continue. Families forced to relocate for work who can't sell underwater homes aren't abandoning responsibility. They're choosing career survival over impossible financial traps they didn't create. Young families choosing strategic default aren't unethical. They're recognizing that businesses make the same decision every day, deciding when to stop funding failing investments. Florida's foreclosure wave is the culmination of every crisis we've documented: insurance explosions, property tax acceleration, price collapse, negative equity, unsustainable ownership costs, and frozen housing liquidity, all converging to force homeowners into foreclosures they don't want, but cannot avoid without destroying their financial futures. The families losing homes will largely rebuild elsewhere: Georgia, Tennessee, the Carolinas, states where housing markets still function, where costs align with incomes, where buying and selling still work, where middle-class families can build equity instead of watching it evaporate. They'll spend years rebuilding credit, rebuilding savings, rebuilding their lives after Florida's cost structure shattered their home ownership dreams. Meanwhile, institutional investors will profit enormously. Foreclosed homes will consolidate into corporate portfolios. Former homeowners will become permanent renters. Florida's transformation from a homeownership society into a rentership society will accelerate. And the next generation of potential Florida buyers will look at foreclosure rates running 3 to 5 times the national average and reach a simple conclusion. The market is broken. Insurance is unsustainable. Property taxes are accelerating. Values are unstable. Negative equity is widespread, and foreclosure is no longer rare. It's systemic, so they'll choose Atlanta, Nashville, Charlotte, functional markets, where homeownership still builds wealth instead of destroying it. If this analysis helped you see Florida's foreclosure wave for what it really is, rational responses to impossible conditions, not family failures, then subscribe to Uncover the Cities. We track the real mechanics behind America's largest housing breakdowns. Like this video. Share it with anyone facing impossible housing math in Florida. And comment escape if you want my framework for deciding whether strategic default makes financial sense in your situation. This foreclosure wave isn't being driven by recession. It's being driven by cost structures that made homeownership impossible for hundreds of thousands of families who did everything right and still couldn't outrun Florida's systematic housing failure.